welcome back to Macro Insight. Today is the 13th of October, 2020. Let's kick off. So, what did we say about last week? We talked about the main kind of theme we were talking about was getting a bit more bearish on risk assets. Why was that? Because we didn't really believe in the stimulus and getting the stimulus done ahead of the elections. And my expectation was that that would keep a bit of a lid on markets. Has that transpired? Doesn't really look like it. So let's kind of delve a bit deeper and look at the charts. So I've been tracking that rally on the NASDAQ from June to early September, you know, from about 9,500 all the way up to 12,500, aggressive rally, what I was calling a third wave of some kind. And then we were correcting, obviously, and the kind of thought process was we were going to carve out some sort of ABC shaped correction into those lows around sort of 10,000, 10,500, and then we would resume the rally at some point. And once we got a bit more clarity on the stimulus and things like that. Now that seems to have kind of already happened. So you could argue that that ABC turned out to be more like this kind of shape and ran out of steam there. If that is true, if that was the complete correction from that third wave rally, then you would expect now we're resuming the rally, which is going to take us to new highs. And then that has the potential to be quite aggressive, because if this is now a 1, 2, 3 formation, then this rally, if it is a third wave on the upside, could start to get quite spicy on the upside, right? And really gain some momentum if we take out those highs. Now, in terms of the market narrative that seems to be driving that, I mean, you know, we had a massive rally yesterday in the NASDAQ of 3%. I mean, Apple and Amazon were big drivers. Apple up 6% ahead of its kind of launch of its new iPhone. Amazon also up 5%. People are talking about, you know, the same story that they were in September about there being quite a lot of open interest in options, short-dated options that's driving this squeeze, where some of this premium that either retail or institutional clients have bought have left dealers short gamma on the upside in the tech space, and that's creating a bit of a panic buying into this expiry. So we have got options expiry, which is usually the third Friday of the month. This is a big expiry, so we've got that coming up. Could that drive a bit more of a squeeze in the NASDAQ? I don't see why not. So something to look out for. Even though things do feel pretty frothy, and it doesn't feel particularly warranted that the market should be up here, who's, you know, that does not to say that it can't keep squeezing, right? And the pain trade, if you think about markets tend to try to find the points of pain. Well, the price action is certainly suggesting that the pain is for the market to keep rallying aggressively. Yeah. So, you know, in terms of the election narrative, the thing that I had been kind of keeping an eye on was like the VIX curve. And to me, the VIX was, you know, very much signaling a high probability of civil unrest or a contested election or something like that, right? Where you've got the front contract at 26.5 and you've got the November contract, which in theory should be pricing a window in time that is post-election. That's actually where the kink in the curve was appearing. And so, you know, that's quite unusual. And that is definitely the volatility market signaling that there's going to be a bit of a contested election, and we're going to have ongoing uncertainty post the election date. Now that doesn't seem to have changed. So even though volatility in general has come down and shifted down, the hump is not being ironed out. The hump still remains in that November bucket, and that is concerning. And that is the vol market's way of saying they don't expect this uncertainty to suddenly be over post-election, right? Now, the narrative to explain the market rally seems to have been that the odds are swinging into Biden's favor, you know, post-Trump getting COVID, even though he seems to have recovered miraculously quickly. The polls and the betting odds are both kind of signaling that Biden's lead is as high as it's been. So he's got like a 10-point lead in the polls. The betting odds are starting to get towards 70-30 Biden. You know, that's also suggesting that it might be what they call a blue wave, right? Where, you know, they take the House and the Senate and the White House, right? So that would, now I would have thought that wouldn't be such a rosy scenario for the tech stocks, given that they've been talking about regulating the tech companies, and because, you know, the fact that they are kind of like monopolies basically. But that doesn't seem to be concerning the market overall. The market overall is loving it. I mean, you had a bit of a bid in the mid caps, which I've generally been quite bearish on, that, you know, they were rallying on the back of the idea that a blue wave is going to lead to a massive stimulus. Even if it doesn't happen pre-election, it's coming, so it's inevitable, and it's going to be over 2 trillion. And market seems to be happy with that for now. And you've also got a big rally going on in the solar stocks, right? Because of the clean energy bill that is likely to come through if the Dems get in. So you've had some quite big outperformance in some of these solar names for the people who are into those sort of growth stocks. So that's been certainly the price action that we've been seeing. Like I say, I don't think the potential for civil unrest post-election has gone completely. I think the volatility market is certainly still signaling that. So that is a risk. But right now, the broader market seems to be comfortable that even if we're not getting a stimulus deal before the election, a big one is coming, and that's generally going to be good for the markets, right? So that's kind of how things are trading. The other thing to kind of be aware of is earnings. So you've got earnings kicking off this week, with particularly the bank earnings are going to be of potential interest. It's not been, you know, whereas equity markets have been very strong, and you normally see that kind of alongside dollar weakness. It's not really been the case this time. So the dollars remained relatively range bound. So it topped out around, if I expand this graph, expand this chart, it topped out around sort of 94.5, come back to here, but it's not breaking to new lows. So until it kind of breaks below 92, I would say, you know, the dollar's still consolidating and basic, forming a bit of a base. And there's still a risk that the dollar can stage some sort of rally at some point, which will be risk negative, right? That should probably put a bit of a cap on risk assets. Certainly commodity markets won't like that, and probably equity market won't like that either, you know. So let's keep an eye on that. So I'd say this level is a big level around this 91.5 to 92 area. If that gets taken out, then yeah, then the dollar longer term, you know, a lot of people are quite structurally bearish on the dollar. And, you know, you could start to see these, you know, 88 target being mentioned, right? But I think this is a very key level where these lows that we reached last time are going to be quite key in the DXY. Yeah. Gold is obviously been on our radar, been consolidating. If I bring this chart up, actually it's probably better in gold. So obviously staged a bounce, you know, on the back of the stimulus talks, kind of suggesting that we're going to get some sort of stimulus, but it hasn't rallied anything like equities has. So still staying within this kind of triangle. So like I said, until gold breaks back above 1950, you know, I still favor the downside continuation towards this sort of 1830 area, and maybe as low as 1760, 1770. That would be where I would be getting interested to add to my longs in gold. You know, I'm still very long for the long term book, but I have got some tactical put options on gold, and I'd be looking to exit those and add more gold exposure should we have that down move, right? But for now, it's consolidating in this triangle. You know, until it really breaks 1880, we're still waiting for that down move as well, right? So it's just coiling right now. But I would expect at some point over the coming weeks for that coil to break one way or the other, and then that will probably trigger, you know, either we're going to get that acceleration to the downside and my puts will pay out, or we break to the upside and I'll probably look to roll my puts because if they've got any premium left in them, right? So that's probably how I'm going to react to that kind of move. Silver, similar story. I did take profit on my silver. I had some tactical longs that I entered on silver when we kind of tested those levels to the downside. I exited my silver around the 25, just over 25 area. So I don't have anything on right now in silver tactically. I would probably pick it back up again if we got back to those lower levels. So I have got some resting bids around 22, and around 20.7. I may even get back involved where I did last time, around 23. I just haven't put that bid in yet, but silver just kind of taking advantage of the volatility of silver because it does have wilder swings than gold. But yeah, right now kind of taking off my long there. When we had that sell-off initially, I took down a lot of my shorts, waiting for a bounce. We certainly got a bounce, got a bigger bounce than I had anticipated. I have been selling into that bounce. I've added some banking, some financial shorts in the US. I've increased my Russell 2000 short. So those are my main short expressions. I've also added a little bit of Germany short in terms of Europe. I haven't really been selling the European market for a while, but I kind of feel a little bit more comfortable selling, looking at the price action in Europe and how it's really kind of struggling to get any momentum on the upside. I kind of fancied a tactical short in Germany to see how that plays out versus, selling the NASDAQ, given the volatility set up in the NASDAQ and how squeezy that market is. I think that's quite a dangerous market to short, where I think being short Germany, I feel like the vol market is actually quite long vol in Europe. That's what tends to happen because there's more systematic like selling flow of volatility in Europe. So that might keep a lid on Europe and make that less squeezy, which kind of makes the short Europe trade, I think, a safer short to play just general equity market weakness, if that's what you think's coming over the next sort of month or so. Whether the dollar bounces or not is going to be the main driver. So, if you look at some of these other commodities, oil, like I say, suggesting that, oil feels a bit topped out. Copper also struggling to make any new highs, even though, we had a little bit of dollar weakness recently. Copper bounce, but it's failing around those. It's not getting to those previous highs. The only commodity that really is going crazy that I can see is nat gas, and I think that's got its own structural reasons. I'm not an expert in, but nat gas definitely looks like it's breaking out to the upside. So I certainly wouldn't get in the way of that. But a lot of commodities, the broader commodity complex, kind of signaling that what was happening in Q3, which was the kind of inflation narrative, the stagflation narrative that was driving markets, the price action in commodities is saying that looks to be slowing down. And there is a risk that in Q4, we actually see dollar up and equities and commodities actually have a bit of a pullback as the kind of reality of the economic growth comes through. And even though we're getting stimulus, stimulus is just a band-aid, right? So, we'll see how that plays out. But, I feel like the market is priced a bit for perfection. Everyone's long the stimulus trade. Everyone expects stimulus to come through and save the market. And, the fundamental forces are still there underlying. And at some point, I think those are going to have to be paid attention to and are going to have to be accepted, right? So that battle between fundamentals and stimulus is still ongoing. And I'm just not sure that the way they're playing it in the politics, I'm just not sure that stimulus is going to be enough to offset what is coming on the fundamentals, basically. Yeah. But the price action is going to determine it, right? If dollar breaks through 92 aggressively over the next month, and commods all start rallying and equities stay bid, then you have to reevaluate that view, right? So I'm running in this tactical account that I trade much more short-term swing trading. I'm generally leaning quite bearish, but then I understand there is a risk that tech is showing very squeezy price action, and if a third wave is about to kick off in tech, that could take us through 13,000 on NASDAQ, and we could get some 99 ridiculous tech rally repeat. And the way I'm hedging myself against that is I've got a few calls in the triple Qs and the S&P to November. I've got not massive size, but I've got a few calls in my back pocket there in one of my sort of options accounts. And if we get some ridiculous rally over the next month, as the market just prices in just the blue sweep and that, it's all good and they're going to stimulate and they're going to devalue the dollar down to, into the 80s, the DXY, that we could easily get a ridiculous rally, and then the gamma shorts in the tech space might exacerbate that. So I think you kind of have to run some out of the money tail hedges using optionality, and that's kind of what I'm doing basically. Thanks so much for watching, guys. If you enjoyed this video, then we'd love to have you join our Macro Insight community. Just visit www.options-insight.com and sign up for your free trial to our live and interactive weekly macro call. If you haven't already done so, please subscribe to our YouTube channel. You'll find more market updates, class highlights from our summer academy, and also video tutorials on anything from options basics to market making fundamentals. You can also connect with me directly. I'm on LinkedIn, Twitter, Facebook, Instagram. You can follow me on any of those platforms. Or alternatively, feel free to send an email to inquiries@options-insight.com. Thanks a lot.